Inderjeet Singh Bhatia, Associate Director with Macquarie Capital Securities, is with us right now. Inderjeet, good morning. Good to have you with us here. Thanks for your time. I just want your first thoughts on the Havells deal, which you wrote about based on media reports, and then now, of course, the deal is out yesterday. Do you think there is more room for re-rating here on Havells?
Yeah, hi, good morning. We actually have also raised our price target yesterday evening to 359 as we factor in this deal to come through. We believe that it's a fairly positive development for this company. It not only kind of releases a large capital deployed in an asset which was not yielding too much returns for this company, but it's also kind of allowed them to strengthen the balance sheet dramatically. So the cash balance would rise by almost 10 billion rupees to go to 15 billion rupees. So we believe that the company is now well prepared to maybe even participate in some of the inorganic opportunities within India. Going by past track record, we don't expect Havells to do anything big bang in nature, but there could be small EPS accretive kind of deals which could come through. So we are very, very positive on the Sylvania divestment by Havells.
You know, in the chat with media yesterday, they said we've always been acquisitive. We always look out for acquisitions. And in a reply, whether they'll return some of this money to shareholders, well, they were non-committal. They said we'll look for the best home for this money, the best way to put the money to use. I thought that was a bit of a disappointment. You don't agree, right? You think it's okay?
I think obviously yesterday, I think any senior management would not want to commit to a sensitive topic like paying out large dividend without having a board approval in place. So I think it's not fair to expect them to kind of commit that. But what we are taking a view is that rather than looking at one-time special dividend, we are more concerned about whether the company raises its sustainable dividend payout ratio going forward, given that the large cash pile that they have. I believe that's a more of a recurring positive rather than just paying out one-time dividend. Second is the company has clearly demonstrated in the last few years that it has done fairly good acquisitions within India. So if they can actually deploy some of that money to grow business in a gainful manner, I don't think investors would mind that. So I believe that there would be a mix of both, a little bit of acquisitions and some increase in dividend, which should be expected from that. I know the management made a comment that they've been acquisitive, but if I look at last 7-8 years of track record, they've been fairly selective within India. Sylvania clearly was their big deal. After that, they have not done anything of a similar size. So, and I don't think there are opportunities within India to kind of acquire companies of a very, very large nature at this point of time. Already, so these acquisitions have to be small in nature.
It's already trading at about 35 times financial 16 earnings, Havells. So isn't it already factoring in all the good news?
I know, but if you look at quality companies in businesses which are more consumer facing, they tend to kind of always get a premium multiple for the earnings visibility, for the cash flow generation, for the ROEs that they generate. And in the last few notes, we have been comparing Havells India business with a model like Asian Paints. Now, both these companies will now start, or I would say Havells will start to generate closer to 30% ROEs in the next 2 to 3 years. Their cash flow generation will improve dramatically after Sylvania divestment. Their dividend payout ratio is almost similar to Asian Paints. And they almost cater to a similar customer segment and similar underlying business drivers. So we believe that Havells should be able to kind of close some of the valuation gap between itself and Asian Paints going forward. And what we would also need is obviously some kind of an economic upturn to happen later in the year or early FY17. And we believe next year going forward with the 7th pay commission increasing, home improvement could actually be one area which could benefit the most from that theme.
Okay, fair enough. You know, I want to take the opportunity of you being on the show to kind of just run through about 8 or 9 names under your coverage. And I want to talk about Adani Port next. You know, when the second quarter results were announced, the stock was 300 plus. It's corrected to 240, 250-ish levels. Your last note is on the 2nd of November on this one. What's your view, Adani Port? Is there value here?
Look, our current view on the stock is we have a neutral rating on the stock, and we have been highlighting a couple of concerns on the name. Obviously, one of them is the coal. Now, this is something external to the company, but way Coal India's production has been increasing and the demand within India has been slightly subdued. Clearly, the imports will continue to decline in India. Government seems to have stated a target that by FY17 end, they want to end all coal imports, barring the ones which are coming for the coastal power plants. If that's going to be a case, then there is going to be a structural problem for Adani Ports for next few more quarters. Second is also the deployment of the excess capital or excess cash that they have. Now, management has stated that they are looking at more acquisitions. Now, we'd want to wait and watch and see how these acquisitions play out, what price they end up paying for these acquisitions or the new organic opportunities that they take up. So I think given that there is a little bit of a both structural and a cyclical problem with Adani Ports at this point of time, and we maintain our neutral rating at this point of time.
Mm-hmm. Your price target is still about 313, right, Inderjeet? But you're neutral now.
Yeah.
Okay, fair enough. Let's get to Adani Power, where on the 8th of December, you lowered your target to, I think, 23 from about 43 odd rupees or so. The stock's about 26 now. Could you outline your thesis there?
Okay. Now, one of the reasons why there was a big cut is also because we actually resumed coverage on Adani Power after a long time because we were restricted on it for certain compliance reasons. So one should not read too much into 43 going to 23. But our concerns are clearly on two areas. One is, despite the company booking a fair bit of compensatory tariff, its interest cover is barely 1.1 times, which is not a kind of a good news. That's one. The second is, despite a balance sheet which is already fairly stretched at almost 10 times debt equity, the company is still open to kind of looking at more acquisitions. So we are not very sure about how this whole thing will play out going forward. And if something goes wrong on the regulatory front and say an APTEL or CRC or a Supreme Court eventually overturns the compensatory tariff decision, then it could be fairly debilitating for the company. So at this point of time, we remain negative on that name.
Okay, let's get to two MNC Capgood names. One is Siemens, the other is ABB. Always have traded at a very high multiple. Are we stretching it a little too far, Inderjeet, here?
I think if I look at the multiples on these stocks, they have. I like to say this always that they have gone beyond sell side purview, trading at valuations of 50, 60, 70 times earnings. I think the market continues to build in expectations of some kind of a takeover by the parent company and trying to kind of delist these entities. My simple viewpoint on that is, at this point of time for ABB or Siemens parent shareholders, it is going to be EPS dilutive if they try to take that company out into private domain. So that's why we don't think these valuation will sustain. And secondly, if I look at the capex environment in this point of time in India, I think private capex is going to continue to remain elusive for another 12 to 18 months. So these companies which tend to benefit the most from private capex will continue to disappoint on earnings, and hence we have a kind of fairly strong sell on recommendation on these names.
You know, your basic argument on Siemens and ABB is pretty sound and people should be able to look through it, right? But still, stocks are held, more stock is bought. They don't correct at all. Why is that, do you think?
I think it's eventually that hope that these stocks will get delisted. I think that keeps the stocks at those kind of levels. Also, you have to look at the effective free float in these names are not very, very large. So that also kind of helps the stock kind of to remain at those unreasonable valuations.
Okay, L&T now. Let's get to that. What's your view there? It's down about 30% in the last 5 months.
I think L&T, there are a couple of big concerns on the name at this point of time. One obviously is what will happen to Middle East with oil now breaking below 40. The situation is till date, we have not seen anything to suggest that the big infrastructure investments in Middle East will slow down dramatically. But that situation, I believe, is fairly dynamic. I think it's very, very difficult to kind of say what the regimes in Middle East will decide one fine day. So I think those concerns and those uncertainties is something which is bringing down the stock. And to be honest, I think we can all take a best guess as to how the Middle East will react to this oil prices sustaining at these levels. So I think that risk will remain. But more importantly, I would say there's been a little bit of disappointment at the pace at which things have been picking up in India. The order finalization continues to be kind of a drag. The company has been citing bureaucratic delays for the project finalization. And we've all been hoping that with this new government, those things get much better. So I think that has been another issue. Another factor which I'm watching out for is that whether the infrastructure margins revive again in second half of FY16. Now, what management has commented that because of early stage project execution, the margins have been lower and it's purely a timing issue. And we are currently assuming that because the infrastructure is the biggest division for them and it's kind of a bread earner for them. So if the margins recover in second half and hopefully along with execution also picks up, we believe some of the Middle East concerns will start to get kind of priced in and the stock should do better.
Okay. Inderjeet, I'm going to take a small detour. Markets have opened, so just like to take note of that. 11 points off on the Nifty, 26 odd points off on the Sensex is what you have. Stocks are starting higher, a little higher, I mean, not too much there. 2.5% on Tata Steel. Vedanta is up about 1/3%. Hindalco, the metal names first, 0.6 odd percent on Hindalco. There's Maruti coming up with about 0.1, I mean, absolutely flat, 4 rupees change. ITC is down about 0.9%, 318. ITC got to about 320 after selling off to about 313, which was the recent low. Maruti on your screen, so nothing there. Dr. Reddy's is up about 1/3. Titan, which is out of the FII limit, is at about 371, 2.5% higher. Dr. Reddy's, some of the cement stocks, by the way, Ambuja, etc., they all remain at a year, 2 year kind of lows. Havells at about 309 is, I think, back at almost yesterday's highs. It got to about 310-ish, Havells, it's back there. So about a 1.5% gain. Reliance, which went up by close, was up 35 rupees, is starting down 3 rupees. That's about 0.25%, 947. Then you have NTPC, Z, both lower. So it's a small change at start, 8 points lower on the Nifty as we stand. Ultratech, Tech Mahindra, Hero MotoCorp, Wipro, Bajaj Auto, and the like. So like yesterday, I think it would be a much better situation if the market starts slower, maybe sells off a little bit more, and then kind of proceeds to rally through the day, rather than the opposite situation, which is a higher start and then, as we've seen for many days, just a complete collapse sometime during the day. 6 points now on the Nifty, 8 points on the Sensex, pretty flat. We are transitioning to getting you everything that is happening across the board, and the most active by volume and price stocks would come up on your screens. So keep with this. Inderjeet Bhatia from Macquarie is with us, and we've been talking about capital goods, the sector he's looking at, and we were talking about L&T. Inderjeet, so just recap your view. You think the price where 1300, 1350 on L&T is a price you could look to accumulate the name?
I would say if you have a slightly longer term view, definitely this is a good price to start accumulating the name. Obviously, what the stock needs is now a bit of pickup in execution and decision making by the government in the second half and early FY17. We would also need, I think, some settling down of concerns on the Middle East, which I think is going to remain fairly dynamic in nature. But oil at $40 or below $40 does not give too much of confidence regarding that. So I think we need India to kind of be strong enough for them to kind of overcome the challenges that they have in the Middle East at this point of time.
Okay, fair enough. Let's get to BHEL. Can you say the same thing about BHEL? It got to a high of about 300 and now back at about 167, 170.
I think BHEL is caught in a very, very structural problems. If you look at, I think if I look at just the longer term view also in that, this government seems to have, I would say, lost a little bit of focus on the thermal power, and it's much more focused on the renewable side for that. And given that the opportunity size in the thermal power generation itself has shrunk significantly, we are talking about 10-15 gigawatt kind of installations happening every year when the installed manufacturing capacity base is around 30 odd gigawatts. So this business is going to remain structurally underutilized. BHEL has a very, very large fixed cost base, and they are up for revision in another 12 months time when their wage pay commission kind of comes in and wage settlements happen. So I think BHEL, we're still looking for a big downside in that name going forward. Even long term looks to be fairly dicey there.
Well, the big rally to 300 which happened in Inderjeet, was that just based on hope that capex would pick up here?
I think initially there was a lot of expectation because power seemed to be, and 24/7 power was a big theme for this government to come in during their election campaign, and people played BHEL as one of the pure power stocks in India, expecting that there would be a big surge in power capacity installations. But the government has gone in a very different direction, and I think with all these climate change talks happening, government is going to have to further restrict its overall carbon, India's carbon release over a period of time, which would also mean that the focus will remain on renewables. So I think those are reasons why now the stock has kind of come off. The order inflows have not been great for the company, though on a year-on-year basis, the things look better in FY16. But a lot of that is to do with, I think, one-time negotiated orders being placed on them, which we don't think can recur every year.
Fair enough. Gujarat Pipavav, you have a price target of 220. What's the thought process there?
I think Gujarat Pipavav Port, according to us, is one of the better power port assets in India, with a backing of a large group like APM, Moller, Maersk, entirely kind of leveraged to the container cycle. 70 to 75% of the revenues being on US dollar denominated. So according to us, they are going through more of a cyclical pain rather than a structural problem. They are adding almost 65% capacity in Q4 of FY16. So that will allow them to kind of a much bigger bandwidth to negotiate with new lines, new customers to bring in volumes into the port. They've also started 2 new business segments, which is Ro-Ro and Liquid. I think with that, there is room for a big margin improvement in that business. The balance sheet is completely debt-free, and they have at various points said very clearly that they would want to pay out very large amount of profit as dividends. So I think with that quality of business, we remain positive on a long-term basis, and though we admit that near-term there are cyclical pressures because of the global trade and domestic consumption being down.
So this the concerns for Adani Port that the domestic coal production is increasing. I mean, that doesn't hold for the Pipavav, right? Gujarat Pipavav.
Exactly, because Gujarat Pipavav's exposure to coal is kind of less than 5% or less than 10% of their volumes. So it's not a big worry for them.
Okay, Crompton Greaves, Inderjeet. What's your call there? In a range for about 18 months or so, not going anywhere.
I think Crompton has been, if you look at from an earnings point of view, there has been a disappointment given we have been waiting for turnaround to happen for a long time. But what we believe in the principal reason for us to have an outperform rating is we still believe it's a great restructuring story. In the next couple of months' time, we'll see the Crompton business being split, 2 different entities being trading. The Crompton's consumer business, we believe, is extremely underappreciated. Now going under a new professional management with very strong leadership coming in, we believe there would be a rebound effect of Havells re-rating on Crompton Greaves consumer also. So that should see a big upside. Then I think the management has also said very clearly that they want to sell out their European business. And if that also happens, we have seen with Havells that the stock can re-rate once you get out of a underperforming business. For Crompton Greaves, the underperformance is much more stark. It's kind of almost 50% of the entire profit is taken away by the losses from their international business. So if they are able to sell that international loss-making business, we expect a much bigger re-rating in that T&D business, because transmission and distribution remains one of the few bright spots in India's capex story. So I think from a restructuring point of view, this is a fairly exciting story at this point of time.
Again, is valuation a problem here or not really?
I don't think so. Valuation, if you start to look at some of the parts and look at more kind of peer group, then the valuations are still reasonable in this name.
NCC, Nagarjuna Construction Company, you've written about it in the past and you like the name.
I think if you look at in a country size of India, we have L&T at the top, and then the second largest construction company is Nagarjuna, which is in terms of revenue size practically 1/10 or 1/8 of the size of L&T. And if you look at today, I think Nagarjuna is the only billion-dollar revenue company in the mid-cap construction space, which seem to have got its balance sheet issues under control. So as we believe, and the government spending starts to get better, they should also have big opportunity in the Andhra new capital construction. I think with that, I think Nagarjuna is very, very well placed to kind of capitalize on that opportunity.
Any other stocks you want to highlight where you might have a strong conviction right now, which we've not discussed, Inderjeet? Yeah, I mean, I think you have coverage on Thermax, you have coverage on Cummins. I didn't bring that up, but you want to talk about those?
I think Cummins is the only other name that we have a outperform rating in the capital goods side. And I would also want to highlight that on the road companies, we'll continue to like IRB and Sadbhav and Ashoka Buildcon.
Right. From within your sector, would roads be the one area where there is most visibility, Inderjeet? Sub-segments?
Yeah, I think the roads, obviously the EPC has the most amount of visibility at this point of time, given where the government focus is at. And I think that's a principal reason why we like Sadbhav, because it is kind of a play on both BOT and the EPC segments for them. Same as with Ashoka Buildcon, that they can participate in both of those opportunities.
Inderjeet, thank you very much for your time. I know you had to run for a meeting. Appreciate you joining us early this morning with that perspective. Thanks indeed.
Thank you.